closely because today we're diving into something that's going to hit millions of American workers starting next year. And if you're 50 or over and pulling in six figures, you really need to hear this. So there's this pretty major change coming to 401k catch-up contributions in 2026 that could mess with both your retirement game plan and your paycheck. And honestly, most people have zero clue this is happening. Let's break it down together. First, I need to be crystal clear about something. I am not a financial advisor, a CPA, or a tax professional. I'm a person who has a background in HR, benefits, as well as risk management, and believes in staying current on upcoming changes to help you understand and stay informed. Everything we talk about today is for educational and informational purposes only. It's not personalized financial advice, tax advice, or investment advice for your specific situation. Your finances, your tax situation, and your retirement goals are all unique to you. So, before you make any major decisions about your 401k, your retirement contributions, or anything else discussed today, please talk to a qualified financial advisor, tax professional, or CPA who knows your full picture. Hey y'all, seriously, don't be making big money moves based solely on a podcast or a YouTube video. Get professional help and take the time to assess your situation. Now let's get started. All right, first I'm going to focus on those that are self-employed or running a small business. There's some really good news for you. Some of the changes and the tax credits that could make starting a retirement plan way more affordable than you think. First, let's talk about what's available. If you're a solopreneur or you only employ yourself and maybe your spouse, you can set up what's called a solo 401k. This is basically your own personal 401k where you get to contribute as both the employer and the employee. In 2025, you can contribute up to $23,500 as the employee, plus catch-up contributions if you're over 50. That's an extra $7,500 or $11,250 if you're between the ages of 60 and 63. Here's the kicker with the solo 401k. The same 2026 Roth catch-up rule applies to self-employed people too. If you earned over $145,000 as W-2 wages in the previous year, you'll need to make catch-up contributions to a Roth 401k account. So yeah, this isn't just hitting traditional employees. You've also got other options like SEP IRAs, which let you contribute up to $70,000 in 2025, or 25% of your profits, whichever is less, and simple IRAs for businesses with few employees. But here's where it gets really interesting. Thanks to something called the Secure 2.0 Act, which builds on the original Secure 2.0 Act of 2019, and is one of the largest packages of tax law changes for retirement plans and individual retirement savings. The government is basically bribing small businesses into offering retirement plans. And honestly, I have to say, it looks like a pretty sweet deal. If you have 50 or fewer employees, you can now get a tax credit for 100% of your startup and administrative costs in the first 3 years, up to $5,000 per year. That's potentially $15,000 in total tax credits just for starting a plan. Most small business retirement plans don't even cost that much to run, so this could literally cover all your costs. If you have 51 to 100 employees, you still get a 50% credit on those costs. Still pretty good. But wait, there's more. There's also a separate tax credit for employer matching contributions, up to $1,000 per employee who earns less than $100,000 per year. This applies for your first 50 employees. The credit is 100% of your match in the first 2 years, then 75% in year 3, 50% in year 4, and 25% in year 5. Let me give you a real-world example. Say you own a 10-person company and you start a 401k. Between the startup credit and the employer match credit, you could be looking at around $13,000 in total tax credits in the first year alone. That's real money back in your pocket. Look, millions of self-employed people and small business owners are skipping retirement planning because it seems too expensive or complicated. But with these new tax credits, the math has completely changed. The government is essentially saying, we'll pay you to set this up. And beyond the money, offering a retirement plan helps you attract better employees and keep them longer. It's a win-win situation. To get these credits, you need at least one employee who's not highly compensated. Basically, someone who earned less than $155,000 in 2024 and isn't an owner. So if you're a true solo operation with 0 employees, you can't take advantage of the startup credit. But if you have 1 employee, you're good to go. If you've been putting off setting up a retirement plan for your business, now is honestly the time. These tax credits are legit and they expire after a certain number of years for each business. So don't leave free money on the table. All right, let's start with the basics of what's changing. Catch-up contributions. You've probably heard of these if you're over 50. They're basically bonus retirement savings you can stash away on top of the regular limit. So in 2025, most people can put up to $23,500 into their 401k. But if you're 50 or older, you get to throw in an extra $7,500 on top of that. And if you're in that sweet spot between 60 and 63, you can actually add even more, up to $11,250 extra. Pretty nice, right? Starting January 1st, 2026, if you made more than $145,000 from your employer last year, you can't put those catch-up contributions into your regular pre-tax 401k anymore. Nope. They have to go into a Roth 401k instead. Let me repeat that because it's kind of a big deal. If you're making over $145,000 per year, all your catch-up contributions have to be Roth contributions, meaning after-tax dollars starting in 2026. That means in your paycheck, after all deductions are said and done, your net pay is affected because the catch-up contributions will be deducted from the net, not the gross. Keep that in mind. Okay, quick time out. Let's make sure we're all on the same page here because this Roth thing trips people up all the time. With a traditional 401k contribution, the money comes out of your paycheck before taxes. So if you're earning $100,000 a year and you contribute $10,000 to your traditional 401k, the IRS only taxes you on the $90,000 that year. Sweet, right? You save on taxes now, but here's the catch. When you retire and start pulling that money out, you pay taxes on it then. Both the original contributions and all the growth get taxed as regular income. Now, with a Roth 401k, it works the opposite way. The money comes out of your paycheck after taxes, your net. So using that same example, if you earn $100,000 in a year and contribute $10,000 to a Roth 401k, you still get taxed on the full $100,000 this year. No immediate tax breaks. Ouch. But the payoff is that when you retire and withdraw that money, it's completely tax-free. The contributions, the growth, all of it, 0 taxes. So basically, it's a question of timing. Do you want the tax break now, traditional 401k, or later, Roth 401k? Let me talk about what this means in real dollars, because that's when it really hits home. Let's say you're 55 years old, making $175,000 a year, and you've been contributing that full $7,500 in catch-up contributions to your traditional 401k. Right now, that $7,500 comes out before taxes, which means your taxable income drops to $167,500. If you're in a combined 30% tax bracket, federal plus state, you're saving about $2,250 in taxes every year. That's money that stays in your pocket today. But starting in 2026, those same $7,500 in catch-up contributions have to be Roth. That means your employer takes that $7,500 out of your paycheck after taxes are calculated. Your taxable income stays at $175,000. You pay the full tax hit. And here's the kicker. Your take-home pay drops by that full $7,500, not just by the after-tax amount. So let me explain that better because it's confusing. Under the old system, if you contributed $7,500 pre-tax, your take-home pay only went down by about $5,250 because you saved $2,250 in taxes. Under the new Roth system, your take-home pay goes down by the full $7,500 because you're not getting that tax break anymore. You're paying the taxes and making the contribution. So month to month, if you're spreading that $7,500 across 12 months, your paycheck is going to be about $625 smaller per month compared to what you're used to. That's real money that affects your grocery budget, your mortgage payment, and your whole cash flow situation. The trade-off is that decades from now, when you're retired and chilling on a beach somewhere, you can pull all that money out tax-free. But you've got to be able to afford the hit to your paycheck today. So who's actually affected? Anyone over 50 who earned more than $145,000 from a single employer. And yeah, that threshold will bump up with inflation in future years. But for 2026, that's the number. Here's an interesting fact. This income test is per employer. So if you're juggling multiple jobs, your incomes don't get added together, unless your employers happen to be owned by the same parent company. And if you switch jobs recently, only what you earn at your current gig counts. So there might be some weird edge cases where you slide under the threshold even though your total income is higher. According to the data, just under 1 in 5 Americans between 45 and 54 are pulling in over $100K per year. When you narrow that down to folks over 50 making above $145K per year, we're still talking about millions of workers. This isn't some tiny group. This is a lot of people. Now here's some good news. If you're earning $145,000 or less, literally nothing changes for you. You can keep doing exactly what you've been doing with your catch-up contributions. You still get that beautiful immediate tax deduction if you want it. You still get to lower your taxable income right now. And here's the best part. You still have total freedom to choose. Want to do traditional pre-tax contributions? Go for it. Want to do Roth? That's cool too. Want to split it between both? Knock yourself out. So if you're under that threshold, you're sitting pretty. You can contribute up to $7,500 in catch-up contributions if you're 50 or older, or up to $11,250 if you're in that 60 to 63 age range, and it's completely your call on how you do it. The bottom line here, this new rule only messes with high earners. If you're below that income level, your options stay exactly the same. You're good. Now here's where things get a little bit messy. About 93% of employers offer a Roth 401k option alongside the regular traditional 401k. That's pretty good, right? But that means 7% don't. And if you work for one of those companies and you're a high earner over 50, you're basically screwed. You won't be able to make catch-up contributions at all starting in 2026. That sweet opportunity to turbocharge your retirement savings, gone. So honestly, job number one right now is to call your HR department or whoever runs your benefits and ask point blank, does our 401k plan have a Roth option? If they say no, and they're not planning to add one, it might be a good time to get with a professional and start thinking about a plan B for your retirement savings, like now. So let's get practical. What are the things that you could actually be doing right now? The first thing I'd say is check with your employer. Seriously, don't wait on this. Find out if your plan has a Roth option. If it doesn't, start making noise. Talk to HR, bug your benefits team. With this rule kicking in, companies without Roth options are basically taking away their employees' ability to save as much for their retirement as possible. And that's just simply not cool. Next, run the numbers. Sit down with a financial advisor. Or if you're a DIY type, use some retirement planning software and figure out whether Roth contributions make sense for your long term. For some folks, they totally do. For others, losing that upfront tax break might hurt more than the benefit of the tax-free withdrawals 20 or 30 years from now. It really depends on your situation. Then, if you're planning to keep making those catch-up contributions in 2026, take a look at your budget. You need to accept that your take-home pay is going to take a hit. Like I said earlier, if you're contributing $7,500 in catch-ups and you're in a 30% tax bracket, that's roughly $625 less per month in your pocket. Make sure you can actually afford that before you commit. Take a look at the big picture. This rule is part of something called the Secure 2.0 Act that Congress passed back in 2022. The official line that it's supposed to encourage more Roth savings, which can be good for people. But let's be real. It's also a way for the government to collect tax money now instead of later. With $37 trillion in a national debt hanging over our heads, this probably won't be the last retirement rule to change that affects high earners. Stay informed and be ready to adapt when they move the goalposts again. I don't want this to all be doom and gloom because there are some legitimately good things happening here. For one, if you're between the ages of 60 and 63, you now get access to those beefed up catch-up contribution limits, up to $11,250 in 2025, and probably even higher in 2026. That's a pretty significant boost in how much you can sock away during those critical years right before retirement. And that's actually awesome. And look, Roth accounts do have real advantages. If you think your tax rate might be higher when you retire, maybe because you crushed it with your savings, or maybe because tax rates in general go up across the board, having a big pile of tax-free money to tap into can be incredibly valuable. You don't have to worry about required minimum distributions forcing you to yank money out and pay taxes on it. And if you pass it on to your kids or any other heirs, they inherit that tax-free status too. So for some people, this forced Roth thing might actually work out pretty well in the long run. It's just super dependent on your personal situation because everyone's is different. Now, here's a quick heads up. Whenever there's a big change to tax rules on retirement accounts, the scammers come out to play. We're already seeing sketchy emails, phone calls, and letters pretending to be from the IRS, financial advisors, or plan administrators, all trying to get your personal information or sell you bogus investment advice. If you get any communication about this 2026 rule change, verify it directly with your actual plan provider before doing anything. Don't click random links in emails. Don't give out personal information to someone who just called you out of nowhere. This is the prime season for criminals to take advantage of confusion. So keep your guard up. Look, retirement planning is already complicated enough without Congress moving the goalposts on us. But here we are. The 2026 catch-up contribution rule change is happening whether we like it or not. The best thing you can do, be prepared. Know the rules, talk to your employer, run the numbers, and make smart decisions about your retirement strategy. Don't let this catch you off guard when January rolls around. And remember, even with this change, catch-up contributions are still a powerful tool. The limits are actually going up, not down. You just got to be smart about how you use them and make sure your budget can handle this switch to Roth if you're affected. Thanks for hanging out with me today, everybody. If this was helpful, share it with anyone you know who might be dealing with these changes. And as always, I'm not a financial advisor, so please talk to a qualified pro about your specific situation. Don't make major money moves based on some random podcast, okay? Until the next episode, I wish you peace, love, and paychecks.